This is the second PowerPoint presentation for week 5, and this one is on the time value of money, and it prepares you for assignment 1. Let's look at the learning objectives of the time value of money concept for this week. By the end of week 5, you will be able to understand and evaluate the cash flows from investments. Investments usually require upfront cash to be spent, and usually you expect the money to be recouped in the future. You do expect the money to be recouped in the future. It may or may not happen. It depends upon the type of investment. The second thing to note is that when you undertake an investment, you're typically giving up current money to get future money. And most people are not willing to give up $100 today to get $100 in the future. So there's a different value attached to current money versus future money. And we want to take a look at that concept to see how it helps us evaluate investment projects. And finally, you're going to actually be able to calculate and evaluate the present values of various investment opportunities. You will be able to take a look at the numbers that we provide. Of course, they're sample numbers, and digging up the real numbers in real life can be complicated. But if you can get numbers, get estimates, the present value concept, and that present value concept will let you evaluate investments and determine whether or not they should be undertaken. Let's start off by looking at investments, both personal investments, corporate investments, and see what sort of cash inflows and outflows are involved when you speak of investments. In general, when you make an investment, it requires spending money today and getting back money tomorrow. We can take a look at a few of them. If you're buying a stock certificate, for example, you're paying out money today to get that certificate. Maybe it's $50 or $100, whatever it is, depending upon how many you buy. And what you receive for that is some expectation of future funds. Stocks don't provide you with any fixed amount that are specified, but if you buy a stock certificate, you're entitled to dividends if they're paid, and capital gains if you actually can get them when you sell the stock. So stock involves some ownership rights in the firm and the right to receive dividends if they're paid out. So this is an expectation of future funds that gets you to spend money today. If you take a look at businesses buying buildings, equipment, or software, they're putting out money today for these buildings, the equipment, or the software, and the expectation is that these things will generate production for them, and that production will bring back cash in the future. So that, again, you're spending money today in order to get future money. In both the case of stocks, buildings, equipment, and software, the funds are pretty uncertain. You're not sure they're going to come back in, but you're hoping they will, and then that's part of the plan that you make when you make these decisions. With bonds and notes have specific future payments attached to them. They will tell you we're going to pay a certain amount of money and when they're going to pay it, and unless the company goes broke, you're going to receive that. So there's still a little uncertainty. I think the only area where there appears to be a fairly certain payment back is when you talk about treasury bonds and notes and something that's called a treasury bill, which is a very short-term treasury security. Nobody really thinks the treasury is going to default, so that's a pretty risk-free security. But again, what you're doing is you're paying money today to acquire that bond or the note or the treasury bill, and it's based upon a promise to pay certain amounts of money in the future. So cash is going out today, and you're expecting cash to come back in the future in order to make this viable. But getting cash in the future is not equivalent to having cash today. People would not be willing to give up $100 today if they were going to only get back $100 in the future. I mean, what you expect to get back are expected future dividends and capital gains. You expect to get back future revenues and profits. If you're investing in buildings, equipment, and software, you're expected to get back interest on bonds and notes. If you're investing in bonds and notes, you expect to get interest back. But the point of the matter is that if you're going to give up $100 today, you expect to get back more than $100 in the future. Otherwise, it wouldn't make sense. You could just hold on to the $100 and have no risk. So future money has to be higher than present money, and the extra amount that you get could be in the form of dividends or capital gains. It could be in the form of revenues and profits. But in the type of investments we're going to take a look at, which are purely financial investments, we'll be talking about interest received. So that if you put out $100 today, you may expect to get back a certain amount of interest, like say 10%, so that at the end of a year, you'd end up with $110. On this slide, we're going to take up the issue of what happens when you invest money today at an interest rate. What will the future value of that money be? Let's take up the example that I actually mentioned on the last slide, where we had an interest rate of 10% and the investment was $100, and we know that that $100 will go to $110 with a 10% interest rate, because every dollar invested for 1 year yields $1.10 1 year later. If you invest it today, it's going to be $1 today. It'll be $1.10. So $100 will become $110. Let's see if we can generalize that formula, where present value is the amount that you currently invest today, and future value sub 1 is the value you're going to receive after 1 year, and R is the rate of interest. If you take the current value, the present value, and multiply it by 1 plus the rate of interest, you get the future value after 1 year. The reason it's 1 plus the rate of interest is because you receive principal plus interest on your investment. And in the current case, if we took that $100, multiplied it by 1.1, 10% interest is shown as a 0.1 decimal. A 5% interest would be 0.05. A 20% interest would be 0.2. 100% interest would be 1.00, and so on. So in this particular case, we have a 10% interest rate, which shows up in decimals as 0.1. So we have 1.1 is the interest rate factor, because it shows principal plus interest. And when you invest that $100 at 10% interest, you're going to get $110 back at the end of the year. So you can see that 1.1 factor is in fact appropriate and correct. You're going to receive principal, which is the 1, plus interest, which is the 0.1, as you invest that $100 for 1 year. So this is a pretty simple example. Let's suppose that we take that $100 and invest it for 2 years. Now, every dollar invested for 2 years is going to end up yielding $1.21 after 2 years, because not only are you going to receive interest for 2 years on your principal, but in the second year you're going to receive interest on your interest from the first year, which is called compounding. The formula for this would be you take the current amount you invest, which we call the present value, multiply it by 1 plus the rate of interest for the first year, and whatever that amount is, that gives you the amount you have after year 1, as we already know. And then you multiply the amount you have after year 1 by 1 plus the rate of interest again, because you're going to get interest for 2 years. And what that ends up being is a formula that says you take the present value, multiply it by 1 plus the rate of interest squared to get the future value in the second year. In our particular example, you're taking the $100, you're investing it for the first year and getting the $110, then investing it for the second year, and that 110 is now invested at 10%, and you end up with $121. The interest factor is 1.21, and you take that $100 for 2 years, and you get $121. In the second year, you receive interest on the principal as well as interest on the interest received in the first year. Again, this is referred to as compounding of interest. Now, there's a general formula that we can get from that, which is that the present value times 1 plus the rate of interest to the n power is equal to the future value at the end of n periods. So that works for 1 year because it's present value plus 1 plus r. For the future value at the end of 1 year, it works for the 2 years, as we just saw, because it's 1 plus the rate of interest squared, and it does work for any year. So that's a general formula that you'd use. Every time you invest for an additional year, you're going to receive the rate of interest on it, so you'd be adding another factor of 1 plus the rate of interest for every year that you invest. So that gives you the formula down at the bottom.